Does a margin meltdown mean a crash landing for stocks? Well, Kara Murphy, Kestra Holdings CIO, joins us now. Kara, the question for you, and this is obviously based on what we're seeing with Target. What do you think?
So I'm going to take the other side of some of the comments that your earlier guest had, and where I think the kind of issues that Target is dealing with today are signs of a broader macro issue. So we are seeing supply chains ease, and those goods are starting to come through that supply chain and land on retailer shelves, just at a time when consumer demand is actually coming down. So that's led to this, start of an inventory glut, and it's high level of difficulty for various retailers to try and deal with this like fast changing environment. But we're seeing on a macro level, supplier delivery times are declining, inventories are rising. All of this is happening really across the economy, and some retailers are better able to deal with it than others.
What's the signal then for the broader economy? Is the consumer struggling? Is this the early innings of the consumer struggling? What is the kind of, just go into a little bit more detail on the macro signals here.
So, we talked earlier about the very strong savings on the part of consumer, very, very strong labor market. Those savings rates are starting to be worked down. People are shifting their buying habits from goods to services. So all of that is sort of like the natural part of the cycle. But I think the key here, what's going to really change consumer buying habits, is weakness in the labor market, which, by the way, we are starting to see. It's very early days, but more signs that we have that the labor market is starting to ease, that will really change consumer behavior and have them start to retrench a little bit in terms of spending.
So, Kara, if you were to put the odds of a Fed engineering a soft landing, what would the odds be? Because that kind of trickles down then into what kind of hard or soft landing we may see, say, in the equity market.
For sure. Now, high level of difficulty, right?
Yeah.
But we still think it's better than even that the Fed engineers a soft landing. And all of the traditional indicators that we look at to tell us that a recession is coming are not yet sending a red flag. And so we do still think that this moderation in demand is going to be the theme for the second half of the year. It's been the theme for the first half as well. And we think that there's a lot of room, you're talking about corporate recession, there's a lot of room in company balance sheets and income statements to have softening, but still be able to continue providing growth.
So Kara, where does the stress come in terms of the profit and loss account? Presumably what you're signaling there is a top line slowdown as well as a margin squeeze. That is terrible for profitability. What is that going to mean in terms of earnings?
Yeah, so right now, we're still looking at about a 9% expected corporate earnings growth for 2022. I think those expectations do indeed come down. But I think the most important impact on a market level that we see are a continuing preference for companies with stronger balance sheets, more reliable cash flows. We've started to see the market, sell out of names that aren't making money, but we'll continue to have this rotation into the types of business models that can better withstand this type of volatility.
Yeah, but what's interesting is that I would think that something like Union Pacific would fit that bill. They're also typically really good at being able to manage these kind of issues, and even they are having operational problems and inefficiencies.
Well, for sure, this is a very high level of difficulty. We've talked about this whole cycle starting with March of 2020 as being a cycle on steroids. Everything has been on fast forward. So even your really well-run companies that have been through tough cycles before are really struggling. But the question is this going to be a one time, and is it going to be a persistent issue? And I think the better companies are going to be able to regroup and understand that we're in a new market environment and be able to react appropriately.
That new market environment, let's just talk about it. How do you see inflation evolving in the kind of scenario that you've painted?
So we think over the second half of the year, we'll continue to see moderation in inflation. On the good side, it's much easier to track that, right? So we can see goods coming through that supply chain pipeline, and they're starting to fill up, and that will bring down goods prices over time in the second half of the year. Services inflation is a lot harder, right? But that tends to be much more tightly linked to the labor market. So that's why we're following those indicators very closely. We're starting to see quit rates increase. Again, just a little bit. It's early days, but they're starting to increase. We have labor force participation rates back to pre-COVID levels. Small businesses are saying they're not going to raise earnings anymore. So I think the more that we see those types of indicators, it bodes well for moderating services inflation in the second half of the year.
Okay, so Kara, based on that, if you are looking at companies that have good quality balance sheets that can make profits, et cetera, where is that right now?
So on a broad level, we're looking at a rotation into value. So more value-oriented names, they have a little bit more cushion because they have lower valuations, expectations are a little bit lower, and you tend to have companies that have, more sort of defensible business models in rough economic environments.
In this kind of environment, how long does the US 10-year stay above 3%?
So we need to be if we're right and inflation starts to moderate, growth starts to moderate, I don't know that 3-year bogey really stays for very long. If past experience holds, then that moderating inflation, moderating growth outlook should start to drop those long-term rates over time.
So does that mean that the Fed can't go as far as we think then? Or are we just going to be in a higher yet subdued new range for the 10-year?
I think the Fed, we're in this moderating environment because the market has already anticipated these rate increases by the Fed. So the Fed has to really continue to press on the brakes. And we think by the latter part of this, and by the fourth quarter of this year, as inflation and growth starts to moderate, that's when the Fed can kind of reevaluate. But they have to be aggressive until they get that. They have to earn the market's respect back that they can actually bring inflation under control.